Greetings, salutations, merhaba, however you say it in your neck of the woods. I'd like to welcome you to another episode of Le Art of Reading Price Action. Again, welcome to another episode of The Art of Reading Price Action. And in this episode, we will be discussing the breakers. That's right, we are discussing the breakers. Now, before we get started, I'd like to let everyone know who's been reaching out to me. The way you join the mentorship is just by hitting the join button here on YouTube. There's a join button that's $24.99 a month. You just click join. You make sure you pick the tier that says mentorship. And then after you do that, go to the membership section in YouTube and join the Discord. And that's it. $24.99 a month. What does the $24.99 a month get you if I'm putting all the videos here on YouTube for free? It gets you access to me. On the second Sundays is Q&A specifically for the mentees, but you have access to the first, second, and third Sunday Q&As because the mentee is the highest tier, and the highest tier gets access to all of the lower tier. So you get 3 Q&As per month on Sundays at 7 p.m. You get a homework review live stream with me on Wednesdays at 7 p.m. unless there's no homework to be done. And that's what you get for the $24.99 a month. And plus you get a chance to be a part of the gang. That's invaluable. Now, without further ado, let's get into the art of reading price action, the breakers. Because these are the breaks. Break it up, break it up, break it up. Now, breakers. What are breakers? Yes, I changed the picture this time. Let me turn on my fancy dancing. Yes, I changed the picture this time. What are breakers? I call them reference points. Why? Because it's not an imbalance. It's just a point in price where the algorithm will refer back to a reference point. So let's read what Michael says a breaker is. For the ideal setup for a breaker, this is a part of order block theory. Breakers are a part of order blocks. It's actually called a breaker block, right? So ideal setup for a bullish breaker is in major to intermediate term uptrends. So if you're in an uptrend, if you're in a major uptrend or an intermediate term uptrend, you want to be looking for bullish breakers at key points, right? Bullish breaker block is a bullish range or up close candle in the most recent swing high prior to an old low being violated. The sellers that sold this low and later see this same swing high violated will look to mitigate the loss when price returns back to the swing high. This is a bullish trade setup worth considering. Meaning, anybody that tried to play a breakout down here going short, once they trade past this high, they know, oh, I'm on the wrong side of the market. So when price comes back down in there, they're trying to mitigate their loss inside this breaker block right here. They're trying to mitigate their loss because they got stuck underwater going short down here in this case. And for those that understand the concepts, this is the long buy-in or long opportunity or bullish opportunity right here at this point when price trades back there. Now, see, repricing higher after sell stops are taken, that's how they got trapped, right? And then market structure broken higher and retracement will be new buying opportunity. See, that's what all of that says over there, right? This trapped them and this offers an opportunity retracing back in here to go up there like that. Hopefully I didn't confuse you. And for the bearish, just flip all of that upside down. We've been doing this long enough, so you know how to flip it in your head. I ain't got to do both on the slides. Now, see how little Timmy Rogers see it in his head. Price will set a low at section A, at point A, should I say. Point A. Price will rally and make a high right there. Point B. Price pulls back and makes a low C that breaks the low of A. Pulls back, make a low of C that breaks the low of A. Right? Now, let me say this. Per Michael, the strongest breakers will occur when you take two levels of liquidity. Meaning, you take out short-term buy stops or sell stops if you're bullish or bearish, and then you take out the higher time frame buy stops or sell stops. Right? So when price is coming down and making this new low of C, if you're going into a higher time frame low here, just after you're taking this short-term low here, then that creates the strongest breakers when you take two stages of liquidity prior to the pang. Okay, all right. Then the break-in market structure qualifies the B to C leg as the breaker. Right. This is the breaker. This is the breaker block here. So when you trade back down into the breaker, then because this leg right here is stopping price, it's blocking price from coming lower. This move down here, it's blocked. So you're really kind of ignoring all of this until it happens. Until this happens, that break in market structure, that's when you start saying, okay, this is going to block price from coming all the way back down, right? And you get long right here at the last up close candle in the move from A to B. And a gem, if you will. If you run a Fibonacci from the A to B and use standard deviation projections, right? That can give you a target of where to shoot to. So if you see buy side or sell side, if you're bullish, resting near a standard deviation, the easiest or the quickest low-hanging fruit would just be one standard deviation of the A to B leg. That's the low-hanging fruit. But if you see swing highs or swing lows in the reverse, that's very near a 2 standard deviation or 3 standard deviation or 5 standard deviation, depending on what time frame you're looking at it on, that can give you your targets of where you want to shoot to by running a Fibonacci from the A to B leg, running it from A to B and then projecting it out. That's a pro tip. Now, let's look at it on the charts. Here we are. If you see here, we got an anticipated resistance or reversal point, meaning we're coming up on a higher time frame high. All right, it can be up higher time frame PD array, but in this case, it's a higher time frame high. So price comes up. This is our A right here. It retraced back, making a low. That's our B right there. And then we go back up. And not only do we take out this high of A, but we go above our old high, our higher time frame high. We go above the higher time frame high. So when we come back down and get our break-in market structure, there's our last down close candle right there in the A to B leg. So now this area here that we were ignoring this area right here until this happened. For now, I'm going to show you a way that you cannot ignore that when we go to the charts. But we were ignoring this for now until we get the break-in market structure. Now we identify this as our breaker and we're looking for the B to C leg to block price from getting back above this high when price decides to trade back to it. No matter when it trades back, as long as the narrative has not changed and the draw on liquidity has not changed, we're expecting this B to C leg to block price. And that's why we got our breaker block. We're looking at the last down close candle or consecutive down close candles. And the lower the time frame you go, the more you focus on the last down close candle because you want to see heightened sensitivity there. Yeah. And here we are. When we traded back into it here, we price traded away and traded back up, hit the breaker, and sold off. That's an example of the bearish breaker. Now, example of a bullish breaker. And in this example, we're looking at a breaker coming down into a higher time frame area of an imbalance over here. Looking at this hourly imbalance is in line with a higher time frame imbalance, right? So we're coming down to an anticipated support level. We're coming down into a higher time frame fair value gap, and it's in line with a hourly fair value gap. Okay, so price comes down here, makes an A. Doesn't quite get to the fair value gap. That's fine. It's coming to it. It's anticipating to do something there, right? We go up, we make a high. That's our B. And then we trade down, taking out this A and trading down into the higher time frame imbalance in line with the hourly imbalance. See how the bodies of the candles are totally respecting that, right? The wicks even respecting it here. And then we take off getting our breaking market structure. Now that we got our breaking market structure, our last up close candle in this A to B leg, now that's our breaker, and we're anticipating this B to C leg to block price and stop price from coming down to this low. And when price trades back to it, bang out, takes off. That's an example of a bullish breaker. Now, let me give you your homework, and then we're going to jump over to the charts, and I'm going to give you a little tip for not ignoring that leg. Remember when I said ignore this B to C leg for a while until you get this breaking market structure? I'm going to give you a pro advanced tip of not ignoring that leg. Now, homework. Go back through price. Let's use the 15-minute chart. If you can't really find a lot of breaker examples, use the 5-minute chart. If you're finding yourself overwhelmed and it's too much, use a 60-minute chart. But the lower time frames you go, the more examples you're going to get. So let's use the 15-minute chart, and I want you to mark out breakers that worked, meaning they formed the breaker, price came back to them and sold off to some liquidity, and take detailed notes on everything you saw happen. You already know how I tell you to take your notes. What time was the breaker made? What time did it trade back to it? Did it take liquidity? Everything you can think of, dealing with all the concepts we went back. Open, high, low, close, imbalances, everything you can think of. Take notes on trading around and to and from these breakers, and also do the same thing, but this time I want you to try to find breakers that failed, meaning it formed the breaker and price just totally disrespected it, went through it and went the other way. Take detailed notes on why it failed. What time of day was it? When did the breaker what did it form during a bullish trend? Did a bearish breaker form during a bullish trend? Take every note that you can on breakers, and you can use the June contract on the ES, or you can use the continuous contract, whichever is easiest for you. Now, let's jump over to the charts, and on the charts here, we're going to focus on this daily breaker here. We got a daily bearish breaker here. Okay. Now, what we're going to do, we're going to go inside this breaker here, because you see we made a high, we made a low, we made a higher high, and then we broke through creating the breaker. But we want to go back before we broke through creating this breaker right here. Remember when I told you that when you take out not only the short-term buy side, but the higher time frame buy side or sell side that you was looking at, those are the strongest. So we're going to go into price here when we took out this buy side, and we're going to talk about some of the power of the breaker, right? Where you can not ignore this part of the price leg, but you can anticipate this breaker being formed and get a better entry. Let's go down to a 60-minute. This is a daily chart. Let's go 2 time frames down to the 60-minute. Okay, so we drop down into a 60-minute, and right here as we are taking not only the short-term buy side here on the 60-minute, as we trade up above, right, we take out the daily buy side right there. And as we go into that, what do? We create a high, a low, a higher high as we take out the daily buy side, creating and then we trade back down and create a daily breaker. So since we're anticipating hitting the buy side on the on the daily, as we anticipate hitting the buy side on the daily and then break down, because we understand that this move up is just, we're going up to break down. Okay, this is our anticipated reversal area. As we go up, go to the 60-minute. As we go up, now that we've hit it, now we're creating a breaker on the lower time frame. Now, mind you, this gray shaded area, that's the daily breaker. It's not created yet, but we're anticipating it to be created. And when we form this breaker here, that's giving us confirmation that price is ready to break down. So now with that information, you can trade a myriad of ways. For example, we go here, take out the buy side. We got a low, we got a high, a low, a higher high. Now we're anticipating this to be a breaker. So now in this area right there, just say you're a turtle soup trader. Once you get this change in the state of delivery here, with this candle coming down and closing below that last up close candle, you can get short right there at the old high, right? Turtle soup trade right there. Once we come down and form the breaker, now we have an imbalance in line with the breaker. Now you can trade the imbalance, the fair value gap, because you got a fair value gap in line with the breaker, right? So then you can take that trade. And also, once price trades down and takes out the sell side here, confirming the daily breaker now, right? Now that we've confirmed the daily breaker, price trades back up into the hourly breaker right there, and you get short on the hourly breaker. So it's on the 8 o'clock candle on April 1st. That was an opportunity for a turtle soup sale. On trading back up on the 3 p.m. candle, because time is important. 3 p.m. candle, you came back into the fair value gap. That didn't give you a lot of chance to trade there, because it just went in there, went to the end of the day. But on the London, with the London, you traded back up and got an opportunity to get short at the London. And then that was on the 2nd, the next day during the London. And then over here on the 4th of April, when you traded back up into the breaker, the hourly breaker, you had an opportunity to get short inside the breaker there. But not only did you get a chance to get short at the breaker, on this time here, if you notice, what did we form as we traded into the hourly breaker, right? We got another high, low, higher high. So we're anticipating this to become a breaker. And so since we're anticipating that to become a breaker, right, this is an hourly time frame. Let's drop down 2 time frames to the 5-minute. Go down into the 5-minute time frame. And once we get inside the 5-minute time frame, if you look here, these are the hourly candles that I circled. Okay. Move this out the way so we can see it. We got our high, our low, our higher high. Then we break down and give us our breaker. When we look at the last down close candle inside that range right there, you have another opportunity to get short when the candle, this candle here, we trade down below the breaker, creating the breaker. We trade down below the down close candles, creating the breaker. And then on this candle here, we trade back up into it, coming to the mean threshold of the breaker, giving you an opportunity to get short immediately on the 5-minute time frame by dropping down 2 time frames from the hourly. When you saw the hourly breaker setting up, you had a 5-minute breaker setting up. So as soon as you got the 5-minute breaker set up, trade it back into it, trade it right to the mean threshold. Let's check that with a fib, because it looks like it's right to the mean threshold. If we go from the high to the low of the candle, let's lock it on. If we go from the high to the low of the candle, the mean threshold of that 5-minute breaker is 52.9475, and the high of this candle right here is 52.9475 exactly. So it came right back to the mean threshold of the breaker and it dropped. Now mind you, if you were trying to get picked up on the mean threshold and it goes to the tick, you may not get picked up, because you need that one little, just the little mohawk above one tick at least in order to get picked up. So with that brings us to the end of another episode of The Art of Reading Price Action. It's your boy, Timothy Lee Rogers Sr. Did I remember to introduce myself this time? I've been forgetting to do that lately. But anyway, if you found value in it, please like, comment, subscribe, share this. Comment and share and like. If the algorithm sees you commenting, sharing, and liking, it thinks you likes it. So please do so. And with that, it's your boy, Timothy Lee Rogers Sr., a.k.a. Araña Grande. That's Big Spider for those who do not hablo español. Man, y'all be safe out in these trading streets, man. Gone. Yeah.